Good afternoon, and welcome to Navigating the Paycheck Protection Program. My name is Dana O'Donnell, Director of Marketing with Schaeferman Lakeland. Attorney Scott Borsak, who is a partner and chair of the Schaeferman Lakeland Business Department, will be presenting today's program. Before we get started, I want to let everyone know that today's webinar is being recorded and will be emailed to you tomorrow. Should you want a copy of the presentation slides, you can download from the Handouts tab. Scott will be taking questions at the end of the presentation, so please submit your questions on the Questions tab, and we will try to get to as many as possible. Let's get started. Scott?
Good afternoon, everybody, and welcome to our program today. Before we get started, I just need to provide you with my one commercial message. Today's seminar is for educational purposes only. It's for the use of our attendees, and nothing about your participation in the seminar today or the questions that I answer from some of you later constitutes the provision of legal services, nor have we formed an attorney-client relationship. There's obviously a lot more information that I would need to be of assistance to any of you. Perfectly happy to do that, but I just want to remind everybody, this is not the forum to do that. So today we're here to talk about the Payroll Protection Program under the CARES Act, and we're going to focus on the view from kind of 40,000 feet. We'll discuss the application process, the spending process, and the forgiveness process. We've done one program just on forgiveness. We'll be doing another forgiveness program next week, and we're looking at a program just devoted to questions and answers, because as it seems, there are a lot of borrowers who have a lot of questions. But as most of you know, the Paycheck Protection Program was a program that was passed by Congress and the President signed into law as part of the CARES Act, an 800+ page piece of legislation. And one part of the program, one part of the legislation in the CARES Act was for this Paycheck Protection Program, which allows certain businesses to borrow up to $10 million. In order to be eligible, the business has to fit the definition of a small business. We'll talk about some of that a little later. The first tranche of this program put out about $250 billion. That money went very quickly, less than 10 days, even with all the glitches that banks had in processing loan requests and the SBA had in approving loan requests. Second tranche opened last week with another $350 billion. And I was advised over the weekend that many banks had hit their allotments already, and that the SBA was almost through with the processing of approvals. So if you're interested in the program and you haven't gotten your loan application in yet, I suggest you do so right now. When the second tranche opened, there was many loans that were immediately approved that were already into the approval queue, just waiting for additional funds. As we were waiting for these additional funds, the media focused on a number of borrowers who took out loans, and because this is a government program, there are websites you can go to see who the biggest loans were, the loan concentration by state, loans by industry, and one enterprising gentleman came up with a way of determining specifically what publicly traded companies had applied for these loans. And I'm sure some of you have seen that publicity. 77 publicly traded companies applied for PPP loans. As of yesterday, 15 of them had returned the funds because of the negative publicity that Treasury started directing their way. Initially, Treasury came out and said that if you're a publicly traded company with access to capital markets and generally well-funded, there's no reason for you to be participating in this loan program. After that pronouncement came out, a couple of days later, another question was published through this process that Treasury tries to provide guidance. The question asked, do businesses owned by private companies with adequate sources of liquidity to support the business's ongoing operations qualify for a PPP loan? The answer to this question, very helpfully, was see response to question 31. 31 was the question where the SBA for the first time put the world on notice that publicly traded companies with other sources of liquidity sufficient to support their operations probably shouldn't be taking these loans. Treasury has said any loan money returned by May the 7th, 2 days from now, will be accepted by the lender, no questions asked, and it'll be presumed by the SBA that by returning the funds, the borrower met all of their obligations, all their certifications, and if they're returning the money, there's no harm done. So there are a number of borrowers who have concerns about whether they are eligible to make an application, whether they're eligible to keep the funds. I would suggest that there are many more borrowers who have qualified to get loans that did so properly within the intention of the statute, who were able to certify without much hesitation that current economic uncertainty makes this loan request necessary to support ongoing operations of the applicant. Notwithstanding, this is still an area of particular sensitivity, and I actually have spoken to a number of borrowers who wanted to discuss their particular financial circumstances around their loans to secure some comfort that there's nothing to be concerned about with some of the adverse publicity coming around these particular questions. But again, if you have that concern, keep May 7th in your mind, because that's the date that Treasury has set for, we can call it borrower amnesty. So the benefits of the PPP program are several. The program is structured as a loan, and if the loan is spent on certain expenses, payroll, rent, utilities, mortgage interest, the principal amount of the loan can be forgiven without any repayment. Now, if the loan isn't properly spent or other penalties apply that prevent forgiveness, the loan basically is a 2-year term loan with interest at 1%. First payment isn't due until 6 months following origination or the date the loan funds. When PPP was originally passed, one of the things that we were told by Congress and the SBA was that the purpose for the program was to support employee payroll. And SBA, in the first round of interpretation, told the world that they have determined that because these funds represent a precious resource and with the express purpose of supporting payroll, SBA said that 75% of the proceeds need to be spent on payroll costs and 25% on non-payroll costs. The other thing we need to be aware of, inside of the CARES Act, there are a number of beneficial tax provisions. There are provisions under both the CARES Act and the first round of relief, the Families First Coronavirus Response Act, which creates a tax credit for qualified sick leave and a tax credit for qualified family leave. If you as an employer intend to take that credit because you have paid or will be paying employees who are going out on qualified family leave or sick leave under FFRCA, you cannot pay those employees with dollars from a PPP loan that you plan on using to support your request for forgiveness. That essentially would be double dipping. By that I mean you're taking dollars from the government in a loan program that grants you forgiveness, and then using the same dollars to secure a tax credit, which the FFRCA provides. So you can't double dip there. Eligible borrower. The program is being administered by the Small Business Administration as a Section 7A loan, and the enabling legislation for the SBA generally and regulations under 7A loans provide that there are only certain types of businesses that are eligible to participate in the program and get an SBA loan. Those requirements are grafted on top of the PPP. So you've got to comply with those requirements as well. Generally, that's going to be businesses with fewer than 500 employees. Now, there are exceptions to the 500 employee limit. There are rules provided in SBA regulations that look to affiliates, other entities with some relation to an applicant. It could be common ownership, it could be common directorship. If the borrower is affiliated with another entity, the employees in that other entity are counted as employees of the borrower for determining the size of the borrower. So if the borrower had 400 employees, but it was controlled by an entity that had 1,000 employees, together it would look as though the borrower had 1,400 employees, and that borrower would be ineligible to participate in the program. The PPP provisions specifically have an exception to the affiliate rules for borrowers that engage in certain businesses with an NAICS code of 72. Those of you who have businesses in hospitality will be familiar with the code 72. Basically, restaurants. So if the borrower owned several restaurants and had more than 500 employees as a result because they own 10 or 12 restaurants, the provisions in the CARE Act would grant that employer an exception to the 500 person limit. There's also a provision in the Act that allows for a restaurant business with more than one location that has more than 500 employees to be considered location by location. So the restaurant lobby got in pretty early in the legislative process, but as we've seen, the restaurant industry was considerably hurt by what's gone on in the last several months. There are other potential borrowers who were not eligible. Those who have principals who have engaged in illegal conduct, or the borrower itself has engaged in illegal conduct. Those borrowers who engage in illicit industries are barred, usually connected to massage parlors and things of that nature. And multifamily residential real estate entities are not eligible for these loans either. Now, I will point out here that The management company that provides services to an owner of multifamily residential real estate would itself be eligible. And since that's where all the employees are, and as you'll see in a moment, it's payroll and employees that drive the loans, the management companies are an important part of all of this. So a borrower is going to be eligible for a loan equal in amount to 2.5 times average annual monthly payroll. Now, as I literally read the statute, what we seem to need is a view toward rolling 12 months immediately before the loan application is made. In practice, what the banks seem to have done almost uniformly is look to the 2019 payroll, looked at the last complete calendar year. When you think about it, that's a pretty easy number to divine. Take out the 4,941s for the 4 quarters, total it up, there's my payroll amount. Take the total, divide by 12, now I have average monthly payroll. It's not so easy. There are other elements in here that have to be considered. The payroll of any employee over $100,000 is going to be excluded. Only the excess is excluded. So if I have an employee who's paid $120,000 a year, $20,000 doesn't come into the calculation, the $100,000 does. Also included in annual payroll cost, beside salary, beside wages, beside commissions, beside tips, payment for vacation leave, parental leave, family leave, medical leave, or sick leave. If I pay someone because I have dismissed them, they separate from service, commonly called severance, that's salary. That's a payroll expense that's included. Most employer payroll expenses are included in the wage base as well. So the employer portion of health insurance and retirement costs are good spends for this purpose. Employer paid state and local employment taxes also can be included in the wage base. But you're not including any of the federal taxes. So no part of the federal taxes go into this base. We're just allowing the state. Now, while there is a $100,000 employee cap on compensation paid to the employee, that cap does not affect the other expenses, the health insurance, retirement, the state and local employment taxes, and so on. So those things can result in the consideration of an employee having costs in excess of $100,000. The other thing that I'll tell you is that certain stipends paid to an employee, a housing allowance, an automobile allowance, if they show up on the employee's W-2, they're compensation, and they are treated as being inside this wage base. There are certain entities out there that are taxed as partnerships. Limited liability companies are the chief example in this category. The owners of the entities are called members. These members provide services to their limited liability companies, and the compensation which the members receive in the form of distributions from their company can also be treated as eligible wage, but it's limited to $100,000 per member. And what SBA is going to do here is look to the income tax return, the Form 1040 of the member for 2019. Look to see either on a K-1 or Schedule C how much net income the employee reported from this limited liability company, and whether that net income was subject to self-employment tax. If it was, the amount that was subject to self-employment tax up to $100,000 is going to be eligible for consideration here. An independent contractor and the sole proprietor can make their own application. A borrower, the party that pays an independent contractor, for example, can't include what they pay to an independent contractor the same way that they would include other wages. The application for PPP is properly made by the independent contractor, not by the party that pays the independent contractor. So independent contractors are told to apply on their own. Loan forgiveness requirements. So the loan proceeds have to be used for permitted expenses, for payroll, for rent, utilities, interest on loans against which business property is pledged and there's a security interest, most commonly thought of as a mortgage that sits on real estate. But the pledged property can also be personal property, in which case the security document is usually a financing statement on Form UCC-1 and supported by a security agreement. But personal property can support this deduction. The loan proceeds have to be spent on eligible expenses within the 8-week period that begins when the loan disperses. That's referred to as the covered period. As we sit here on May the 5th, anyone who receives a PPP loan today will have no problem spending their money within 8 weeks and this second deadline, which is June 30. The CARES Act provides that it's expected that through June 30, PPP loans are going to get spent. Now, a lot of these loans were dispersed earlier in April. So the 8-week covered period ended sometime before June 30. The SBA has said, and the legislation provides, you're eligible for forgiveness on what you spend only during the 8 weeks. If you don't spend it all in the 8 weeks, so long as you are spending the money on a permitted expense, you can continue using it, but only through June 30. So, we talk about 2 lines here. You have 8 weeks to get forgiveness for what you spend. You have until June 30 to get rid of the money on eligible expenses. After that, you're not supposed to be spending the money. After the June 30 deadline, you're not supposed to be spending these funds. It's a little confusing, but again, for those of you who are getting loans now, 8 weeks from today is June 30. Now, if your loans don't fund for another couple of days, your 8-week covered period is going to extend beyond June 30, but the legislation says you're supposed to have spent all your money by June 30. I suspect that there's going to be further clarification coming from the SBA to soften the June 30 deadline by a couple of days. Now, several people have asked me previously whether the SBA is going to extend either the June 30 date or the 8-week covered period by 6 months to allow people a longer period of time to spend these funds, because many employers haven't reopened yet. Some employers have been sitting on loans for 3 weeks and they haven't paid their employees a penny. There's been some chatter about extending those dates, but until there's legislation advanced that the president signs or the SBA grants some specific relief, I wouldn't count on any of that. And assume that you've got 8 weeks to spend this money on eligible expenses. And for some of you who are listening, it actually may be a couple of days less than that. If you follow these rules, some portion of the loan or all the loan can be forgiven. If the loan is forgiven, another provision in the CARES Act says, notwithstanding what the Internal Revenue Service provides for recognition of taxable income when a taxpayer is relieved of a debt, the forgiveness of a PP loan does not result in the recognition of taxable income. So if you get a PPP loan for $50,000 and you spend it on eligible expenses within the time period, and your bank grants you forgiveness on the loan, you have no taxable income on account of the forgiveness. And yes, I did just say your bank grants you the forgiveness. And we'll get to that a bit later on. So the forgiveness portion says the amounts you spend must be paid and incurred, or incurred and paid, in the 8-week period that begins with the funding of the loan. A lot of people ask whether, when their loan funds, if they can reimburse themselves for expenses they paid prior to the loan, or pay expenses for invoices that they've gotten before the loan issued, or covering a portion of their payroll or rent prior to the loan funding. And the answer to all those questions is no. People ask whether I can pay 6 months of rent or anticipate another payroll and use PPP money for an additional pay period, or pay 3 months of utility charges, or pay my employees more money. All but to pay the employees more money, the answer to the question is no. The legal obligation for the amount that you're paying has to arise during the 8-week covered period, and you actually have to pay the bill in the 8-week covered period. So you can't pay payroll in advance. And as a matter of fact, while you can raise the compensation level that you provide to your employees, no employee during the covered period can get more than $15,384. The magic of that, 100,000 divided by 52 weeks times 8 weeks. It's the maximum amount of compensation the employee can be paid to support forgiveness. There's no connection between that figure and the expenses the employer pays in addition to payroll for things like health insurance and retirement costs and state and local employment taxes. So it's $15,385 plus all those other costs. Since one of the primary purposes of the PPP was to get income to employees as quickly as possible, using payroll providers as the means of dispersing these federal funds, Congress built in a couple of penalties, consider them additional hoops to jump through in trying to comply with the burdens to get forgiveness. If the employer experiences a reduction in their workforce, then there can very well be a reduction in the amount of expenditure that's eligible for forgiveness. Likewise, if one or more individual employees receive less in compensation during the covered period than they did in the quarter before the covered period, there could be a reduction in the amount eligible for forgiveness. The Act does allow for a mulligan, a time to cure these things, so long as these bad events, either reduction in force or reduction in employee payroll, occur between February 15th and April 26th, and are corrected by June 30, then these bad acts are forgiven. And we'll go more into the detail of those acts momentarily. Regardless of whether you fix either of these two, in order to get the forgiveness, you actually have to spend the money. So it's not enough that you hire back the employees or you increase the pay rate that they once got. You have to pay these employees, and you have to pay them at the right pay rate so that when you compare what they would have, what they should have received in the 8-week covered period to what they actually did receive, at the rate they enjoyed in the quarter before the loan originated, if there's no equivalence there, there's going to be a reduction in forgiveness. I know sounds confusing. Let's get into some of the details, and we'll clear some of that up. Workforce headcount. We're looking at full-time equivalents, individuals who work more than 30 hours a week. And there's nothing in the CARES Act that identifies FTEs as individuals who work 30 hours. The SBA guidance produced thus far says nothing about FTEs being individuals who work 30 hours. The last time the SBA used full-time equivalents in a regulation, a couple of years ago, they identified FTEs as those who worked for 30 hours. And anyone who is familiar with the requirements under the Affordable Care Act, full-time equivalents were identified as those who worked 30 hours in a week. So we're using 30 hours until somebody tells us otherwise. 2 or more employees can aggregate to 1 FTE. So if you have 2 individuals, one who works 20 hours and one who works 15 hours, the 2 of them together equate to 1 FTE. We have to pick a measuring period here, and except for seasonal employees, which have seasonal employers, which have a whole different rubric and a bit more complex, more so than we can go into in today's program, but I can speak to people individually on that. The 2 measuring periods we get to choose, and we just pick one, and spoiler alert, I think you ought to pick the one with the fewer number of FTEs, are February 15th, 2019 to June 30, 2019, and January 1, 2020 to February 29th, 2020. Determine the average number of FTEs in the pay periods involved, and that's the number that we're using for purposes of testing. In looking at headcount, we look at all our employees. Doesn't make a difference what they got paid. If they're employed full-time, part-time, they all count. They're all part of the analysis. Going to come up with the average number of FTEs per month during the selected period. As I point out in the materials, I know this is a little awkward because we have one period with 2 full months, another's 4.5 months. We're going to make a determination by pay period occurring, pay periods that occur in a month. So if you're an employer who pays your employees weekly, you're going to be looking at 30 hours a pay period to draw the line. You pay bi-weekly, every 2 weeks, 60 hours determines your FTEs. And if you pay twice a month, an FTE will be working 65 hours in a pay period. I've mentioned a couple times a penalty for bad action or inaction. If you have a workforce reduction, that is, the number of FTEs during the covered period, the 8 weeks after the loan funds, is less than the number of FTEs you had in either of those 2 periods, the one which you picked, you could have a reduction in the amount of eligible spend for purposes of forgiveness. So if you had 10 FTEs before the loan, 8 FTEs after the loan, you've had a 20% reduction in FTEs, you would suffer a 20% reduction in the amount that would be eligible for forgiveness. If you do find yourself in a situation where you have fewer FTEs after the loan, it is possible to fix this mulligan that we'll talk about in a few moments. The penalty is based on a fraction. We're going to look at the number of FTEs after the loan divided by the FTEs before the loan. The reduction fraction is multiplied by the amount of eligible expenditures that you make during the loan period. That product is the amount of your spend that's no longer eligible for forgiveness. I mentioned the mulligan, a do-over, a chance to fix something that you did. As an employer, if you had a reduction in force from February 15th to April 26, 2020, you can undo the reduction and ignore that change. You need to hire laid off employees, and if you do that to the right number, your reduction in force can be disregarded. The restoration has to occur on or before June 30, and you get another break here, potentially. You only have to hire enough FTEs so that your workforce during the covered period equals the average FTEs you had on February 15th, 2020. So if you had 10 FTEs in your measuring period and you had 9 FTEs on February 15th, and you had 8 FTEs during the covered period, the 8 weeks after the loan originates, you only have to rehire 1 FTE to get to 9, the February 15th number, to avoid headcount penalty. But as I said a number of times, you still need to spend the money. It's not enough just to hire the person back because there's also a salary test. One of the questions I get asked about the most is the interaction between unemployment and trying to rehire an employee. For purposes of the headcount test, you can hire any employee, somebody who provided services to you or an entirely new person. We'll see when we get to the salary test, we want to hire the same person, but for the headcount test, it doesn't make a difference. Well, what if you furloughed your employees, you're paying their health benefits, they're out on unemployment. In New Jersey, unemployment is pretty generous. The maximum amount an employee can receive in New Jersey before the pandemic bonus for unemployment was $711, which equated to 60% of wages available for credits of about 1,100, I think was the number. So with the pandemic bonus, employees can receive $1,300 in unemployment benefits. Well, if your furloughed employees were receiving $1,000 in wages but are getting $1,300 on unemployment, and you call them back because you've got 8 weeks of PPP and you want to pay them, and you got the loan because you were being a responsible employer and you wanted to take care of your employees, this is going to be very difficult. The SBA Sunday night came out with some guidance on the area of employees who are laid off, which I would suggest is political correctness for somebody who was fired. In their words, an employee who is laid off, who is then called back to work by the employer and refuses to come back, won't result in a penalty to the employer. So as we'll see when we get to the salary test, the fact that you can't bring back the specific employee, if you fired them, if you laid them off, won't trip one of these employee tests for determining eligible expenditure. So let's get to the payroll reduction test. What are we looking at here? We're only testing employees whose salaries were under $100,000. So unlike some other inquiries, if you have a group of employees who were paid more than $100,000, put them to the side. We don't have to test them. You want to cut their salaries, you can. But so long as they're over $100,000 at the rate that you're paying them, there's no test to determine whether there's a reduction in penalty. They all have to be employed in the full calendar quarter before the loan originates. So given where we're sitting right now, that's all going to be the first quarter of 2020. The salary of each employee in the 8-week period after the loan originates can be no less than 75% of what the employee would have made at the average rate during the first full calendar quarter of 2020. Those employees who were not employed by you during that calendar quarter, not tested. So that quarter ended the end of March. Some of you are getting loans funded now in May. So the employees in April, whatever employees you had or who were brought on in April, if any, aren't included in this inquiry. The ones who were employed in that quarter have to be paid after the loan originates 75% of what they would have made at the rates that they were paid in the first calendar quarter. This test is specific to individual, which is why that bit of SBA relief was important when we're talking about laid off employees who wouldn't come back to work because they liked unemployment too much. If I have employees A, B, and C, and I laid off all of them, and I brought back employees D, E, and F, and I paid D, E, and F exactly the same wages I paid A, B, and C, I'd be fine on my headcount test because I had 3 FTEs before, I have 3 FTEs after. The place where I suffer is I have no wages for employees A, B, and C, and I can't fix that under literal interpretation of the law. I can't fix that by hiring 3 new employees. I still end up with a salary deficit for A, B, and C. So this is all specific to the individual employees that I had in that calendar quarter. Now, I'm looking at payroll before the loan over the course of an entire calendar quarter. I have to pay employees over an 8-week period. I obviously can't pay in 8 weeks what I paid in an entire quarter. So I suggest what SBA is looking for here is what was the average rate or average amount paid in a pay period that I paid this employee in that quarter before my loan originated. That becomes my touchstone. So if I paid an employee $2,000 in a pay period, I would have to pay that employee 75% of that amount after the loan, or $1,500, in order to avoid a penalty under the salary reduction test. Employees during the 8-week covered period have to receive at least 75% of what they would have received, or what they did receive, I'm sorry, during the prior calendar quarter. To the extent that a specific employee is paid below the 75% line, that deficiency serves as a dollar-for-dollar reduction on the amount of forgiveness the employer is entitled to. Here we have another mulligan. Salary reduction between February 15th and April 26th. If we restore the rate of pay to the employee to their average rate on February 15th of 2020, and we do that before June 30 of 2020, and I suggest spend or pay the employee what they would have received at that proper rate, the fact that we cut them and then raise them will be forgiven and will be treated as if we did not reduce their salary. But again, I have to emphasize, if you short the employee $500 and we have to get $250 back in the employee's pocket to get to 75%, you actually have to pay the employee that amount. It's not enough to say, okay, I'm going to raise your rate to what it was. You have to spend the money. The employee needs to get back pay. So we have the two mulligans for rehire and salary corrections. If an employer who has a reduction in force and reduces salaries, if he fixes one, has he avoided both penalties? Early on, some people were suggesting that in reading the statute, you only had to fix one penalty. The salary reduction is excused if a reduction in salary is corrected to the salary level that existed on February 15th, and we actually paid the back salary during the 8-week covered period. Forgiveness won't be affected. The reduction in force, again, we go and hire somebody back to the number of FTEs that we had on February 15th. We have no adverse consequence from FTE reduction. So some people were suggesting that you only needed to correct one of these deficiencies to ignore both of them. I'd suggest to you that as the statute is written, it talks about circumstances which can be ignored, and the reductions are ignored if there is a correction. If you fall on the wrong side of both salary reduction and headcount, or reduction in force, the only way to cure the penalty potential is to eliminate both of the penalty situations. It's not enough to fix one. You only have to fix one of these penalty circumstances if you commit only one. If you commit both, you must cure both. This isn't an either or. I've said several times, the borrower has 8 weeks from the day the loan funds to spend the proceeds. PPP puts an outside date of this on June 30. And if you were a borrower who had more time because your loan funded earlier, there would be a window from the end of your 8-week period until June 30. PPP allows you to continue spending the proceeds of a PPP loan to June 30. You're not going to get forgiveness on what you spend between the end of the 8-week period and June 30, but it is a proper use of the money if you spend it on eligible expenses. And as I said earlier, anyone who's funding today or later doesn't have that opportunity because your 8-week period is going to carry you after June 30, and there's going to have to be some further guidance coming from the SBA. I suggested in probably what seems like 45 minutes ago, because it was, that the request for forgiveness is made to the lender, the bank that you got your money from. The SBA isn't providing the front line here. The banks are doing the underwriting inquiries on the amounts to be forgiven. The Act requires that you cannot get forgiveness without documentation. So you're going to have to put in documentation supporting your payroll costs, showing how you've determined full-time equivalents, and I think you've got to get as granular as showing what each individual employee was paid during the covered period versus what they earned in the quarter prior to the covered period, because the salary test is driven by individual employees. You know, if you've got 10 or 15 employees, that kind of granularity is probably not that difficult for a bank to handle. If you have 200 employees, it's probably next to impossible. But it remains to be seen what the SBA is going to do about that. As far as eligible expenses, you have canceled checks, bank statements, leases, utility bills to support the non-payroll expenses, payroll charges, compensation paid to employees. You're going to have all the output from your payroll provider. The borrower is also going to have to sign a certification that all the documents here were true, accurate, and correct. Get all that together, submit it to the bank. The bank's got 60 days to make a decision on the request for forgiveness. And just before we turn to questions and answers, I want to share one observation. The banks have the ability to pre-sell the loans before they get proof of forgiveness from individual borrowers. So the bank could sell your loan before you've determined how much is forgiven. And if the bank has sold your loan for 100 cents on the dollar, it's possible that they set up this adversity of interest with the borrower where the bank is able to profit if they deny you forgiveness. So I think this is something we need to pay careful attention to as the banks start processing these forgiveness requests. I can't tell you what the manner in which the banks are going to require all this information because the banks are working on it. I'm hopeful that the banks provide this detail and that they have websites you can upload information to. Dana, do you have a couple of questions?
Thank you, Scott. Yeah, I have a bunch of questions here for you. The first one, is loan origination when the loan is approved or when the loan is dispersed?
It's when the loan is dispersed, when the funds hit your bank account.
Okay. Next one, do you need to have the exact same number of employees on payroll to have the loan forgiven? If so, do the employees need to be on the payroll for the entire 8 weeks or on a specific day?
You need to have the same number of FTEs, full-time equivalents, and it is an average over the 8-week period. So if you need to get to 10 FTEs and you have 12 FTEs for a couple of weeks, let's say it's 4 weeks, and you have 8 FTEs for 4 weeks, then you end up with 10 FTEs over the 8-week period.
Okay. Can employees with salaries above $100,000 be counted in both FTE and salary tests, but only up to the $100,000 threshold?
So all employees are considered in the FTE test.
Okay.
Only employees whose compensation is under 100,000 are included in the salary test. I'm sorry, I said that wrong. All employees are counted in the FTE test. Only employees with salary under 100,000 are counted in the salary test. That's right.
Okay. What eligible expenses can home-based businesses pay for with this money?
Salary, compensation to the business owner up to $15,384, and utility charges. That's it.
Okay. Can you get partial forgiveness for your loan, or is it all or nothing?
You can get partial forgiveness, and there's really several hoops to jump through here. The first is, no matter how you spend the money, you're only going to get forgiveness on no more than 25% of your non-payroll expense spend, which would leave you 75% for your payroll spend. Some people spend more than 25% on non-payroll costs, so they're not going to get forgiveness on the excess there. So that reduces some of your forgiveness. The FTE test can reduce the amount of eligible spend for forgiveness by the percentage reduction in your workforce. And if you don't pay your employees enough, the salary test will also reduce some of your eligible forgiveness. So it's not all or nothing, and many borrowers will have percentage forgiveness.
Okay. Are bonus and or additional hazard pay allowed under PPP?
Yes, they both are, so long as no employee receives more than $15,384 in total.
Okay. I think we have time for one or two more questions. If employees refuse to return to work, how does that impact the forgiveness calculation?
So if the employees choose not to come back to work, but you hire new employees to replace them, you can correct the full-time equivalent deficiency because you can bring your headcount back to where it was prior to the loan. The place you can't correct is the salary the employee isn't being paid after the loan originated. So an employee who got $2,000 in a pay period prior to loan origination in the first quarter of the calendar year, they're getting paid nothing during the 8-week period after the loan disperses. So we're responsible to pay that employee 75% of what he received prior to the loan. So in each pay period, there is a $1,500 forgiveness penalty. And even if we spend all of our loan money, we're not going to get forgiveness for that $1,500 in unpaid salary to a specific employee who didn't come back to work. Now, again, I mentioned the laid off employee exception being excused by the SBA. So we'd have to look at the grounds under which a particular employee left, whether they were laid off, quit, or furloughed, and all that impacts on the current state of guidance. I'm sure the answer to this question is going to change as we get deeper into the loan process, and SBA will consider further whether it just applies to laid off employees or furloughed employees as well. How about one more, Dana?
Sure. What if we are seasonal and had no payroll in the first quarter, but we start in May with our payroll?
Seasonal employees have a different set of rules, and there is specific guidance to deal with seasonal employees. Probably not a good question. The person who asked that question, why don't you send me an email and we can talk about seasonal employees offline. Last one, Dana. I feel like I didn't answer that question.
Let's see. Let me try to find a good one. For businesses closing on loans in the second week of May, when will the dates for calculating FTE test and deadline for use of the money be for forgiveness?
So the pre-loan testing periods won't change. You'll be looking either at those 12 weeks in 2019 from February to June, or the 8 weeks from January 1 to February 29 for FTEs. And the Mulligan date for FTE measuring, if you're going to try to correct a deficiency, is still going to be February 15th. I don't think the SBA by regulation is going to change any of that. So those measuring periods don't change, and we're going to look to the average number of FTEs that the business employs in the 8-week period that starts when the loan funds, the dollars hit the bank account.
Okay.
I'd like to thank all of you for attending today. It was my pleasure to share with you some of this somewhat confusing information. If you have further questions, you have my contact information in the materials. I think the materials will be sent to all of you. And of course, I'm available for consultations to help you through questions of both application as well as the spend and forgiveness. Thank you all for attending, and stay safe, everyone.